All right, it looks like Blackstone is pulling back on purchasing single family homes in about 38 markets across the country. Is this a sign of things to come? What do they know? How is this going to affect the foreclosure market? We'll talk about that in a second. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Burns, Crashes, Turns, whatever, because you know it's going to happen, right? Welcome again. Today is the 29th of August. It is almost over. The month's almost over. We're going to be in the fall pretty soon here. Randy Patrick putting the realism back in real estate. Hope you're doing well. Guess what? This video is brought to you by our friends at foreclosure.com. If you're looking to find and pick up distressed properties in your neighborhood, your neck of the woods, go to gethousingdata.com. That's gethousingdata.com. That's my affiliate link. You can check out what's going on, again, in your own backyard and see all the distressed properties that are available for you to get your hands on. So go check that out, gethousingdata.com. Now, just to kind of tie things up, we talked about, the foreclosure tsunami, how that's kind of coming through now, how they're going to affect the marketplace. So what we've gone through the past couple of videos is I said there's going to be three waves. The first wave was, the pre-COVID, pre-2019 stuff. The second wave is pandemic related. So now we're going to be talking about the third wave, okay? But the third wave is kind of neat because this whole Blackstone thing kind of impacts that as well too. So the housing correction intensifies, okay? Blackstone to stop buying homes in these 38 regional markets. So again, they're going to pull back in a bunch of markets. It's not all the markets, it's a select number of markets. But why this is kind of important is that you can see that even large investors who buy thousands and thousands of properties every year, rent them out, fix and flip, or do whatever, they go through a period or they go through a process of normalization on their asset base. What they do is they go, let's take a look at markets that are so called frothy, all right, maybe a little high priced. They take a look at their buying, they take a look at their returns and say, you know what, maybe we're going to pull back, or maybe we're going to sell some of our inventory for various reasons. So this is interesting. If Blackstone is doing it, more than them will be doing it as well too. So basically the pullback is by Home Partners of America, which was purchased by Blackstone in 2021 for $6 billion. This comes as average Joes and investors alike put their home buying plans on hold. The result isn't pretty. On a year-over-year basis. Existing home sales and new home sales are down 20% and almost 30% respectively. So yes, so now we're starting to see the market cool off to correct. Basically, why this is interesting? Well, it just comes right after we've heard a couple of discussions on where property values are going to go or where they're headed over the next couple of years. Fitch Ratings released a report that said 10 to 15%, devaluation, some markets being 25 to 30. Moody's basically said a 5 to 10% could manifest. So again, a lot of these economists and groups that are in the financial world are coming out now saying that we are going to see downturn, we're going to see home price depreciation, declines in values, and they're calling the numbers, which I think is interesting. Clearly, yes, if you've got deep pockets like the Wall Street groups, like Blackstone and other investors out there, your returns maybe are a little different or a little more modest compared to the mom and pop investor. But in the end, it still has to make sense. So they're going to look at these markets and they're going to figure it out. So this basically is a quick map across the U.S. The red little icons or dots there are the locations, to which they're going to pull back. This is kind of the first wave here. So what do we got? We've got Spokane, we've got Boise, Reno, Vallejo, Fresno in California, Tucson, Albuquerque, Wichita, Omaha, Des Moines, Louisville, Lexington, Fayetteville, Arkansas, Little Rock, Arkansas, Baton Rouge, New Orleans, Memphis, Huntsville, Alabama, Knoxville, Asheville, Greenville, Augusta, Akron, Columbus, Myrtle Beach, Charleston, Lakeland, Deltona, Springfield, Madison, Milwaukee, Grand Rapids, Detroit, Fort Wayne, Virginia Beach, and Cincinnati. Just FYI here, the map only showed 36, these 36 cities, even though the article states 38. So if you're counting, there is a little discrepancy there in the article. But I guess either way, this is the main haul of what they're going to stop investing. Now, for example, I'm not too far from Lakeland. I know what's going on there, and yeah, Lakeland was a little better priced area here in Florida, so a lot of investing has been happening there. When people notice that, they all jump in. It gets a little too hot, a little too frothy. There's some pullback, all right? They're going to look at demographics. They're going to look at rent rolls. They're going to look at a lot of appreciation, cost of doing business there, materials, whatever. They're going to look at a lot of things. But again, These are the prime 38 where they're going to, or 36 of the 38 that they're going to pull back. And it represents only a small part of their overall buying, we'll call it power or what they're doing, but in the end, it's got to make sense for them, right? Oh, and by the way, if you're not a subscriber to my channel and you appreciate the information I provide, if you could do me the great honor and smash that subscribe button, I'd really appreciate that. And if you're a subscriber or think you are, could you please verify and resubscribe? Because I lose subscribers every day. All right, thank you, everybody. I appreciate that. So here's the scoop. So to me, that's a sign. So if these big investors like a Blackstone, like other ones like America Home for Rent or Waypoint, whatever, if they're going to pull back and normalize, that shows us, number one, that we're at the peak or we're actually past the peak. Number two, they're going to be careful and monitor how they're going to implement and deploy their capital and which markets they're going to jump into heavily or pull back on. So we should take this as another warning sign, another kind of signal to that, hey, the market's changing. So how does this all affect the foreclosure market? Well, again, we've talked about the first two waves, so this is going to be the third wave. And the third wave to me is kind of post-pandemic, kind of like where we are now through to the next 3 to 4 to 5 years. All right, it's going to be the result of economic distress because we do have inflation, we do have reinvigorated mounting job losses, we certainly have higher interest rates. The Fed has stated itself that they're going to continue to raise interest rates, and they don't see slowing that down for the next little while. Yeah, maybe it'll be 50 basis points as opposed to 75, but who knows? But the point is, they're going to continue to do that, which means it's going to put more pressure on sellers to reduce price point to accommodate home buyers. So we will see market turn down and correction just for those reasons alone, trying to put things back into a normal world. And then what's going to happen is sellers are going to go, okay, well, because the market's changing, I need to cash out now. So in a way, you kind of got the fear of FOMO, the fear of missing out on the way up, okay? And then if you need to sell, you've got FOMO, fear of missing out on the way back down because you want to catch it. Like they always say, you're trying, don't catch a falling knife, but you gotta get your spot somewhere where you can cash out. So we're going to see people who are going to go, we've peaked, I see it sliding, I need to put my property up for sale or reduce price points to get what I can for it before it drops down too much. So, and again, this will be, I don't call it mass hysteria, but this will be triggered by the first and second foreclosure wave. So right now, as we're having corrections that are going on or starting because of nothing but inventory, like lack of inventory oversupplies on the new housing side, more inventory coming on the marketplace now in many of the regional locations. We've got the interest rates that are reducing a buyer's buying power. So sellers have to accommodate. So we'll have more competition. As I said, our inventory is up to about 3 months now, as per NAR, the last report they had. New home inventory is over 10 months. So that's beyond a balanced market. That's now that's really a buyer's market in that respect. So we're going to see all these things happening, and the first and second foreclosure waves aren't really even here yet. So that's why the third wave will have all this going on, plus the impact of the first and second foreclosure wave, which will basically destabilize the market, drive more price points down, provide more opportunity for purchasing at distress and lower price levels. So all that kind of messes with people who took loans, who took FHA type loans with low down payment. Because remember, you take a low down payment loan, 3.5%. Well, if you have to sell it next week for whatever reason, you're already underwater because closing costs and commissions are at least 7-8% from the sale price. So you're underwater. You got to bring cash to the table. So it's kind of what goes on in the marketplace here. So as I said, the third and final wave will be based on correction happening now, and then result of we'll say increased inventory or increased lower price inventory or increased, we'll call it fear of missing out, fear of crashing markets, etc. with respect to the first and second waves of foreclosures manifesting through the marketplace. So it's kind of like your housing bubble starting in 2007 and sort of crapping out and sort of doing its little routine and then really coming out of the trough in 2012 or 13. So as I said, we've got 3 to 5 years of this. Buckle up. It's going to be a wild ride, but we got to get into it now. I mean, this is what's going to really happen. But again, the whole stuff, when you see large investors pulling back, and as I always say, it's the boots on the ground, the feet in the street. It's the people who are actually in the marketplace directly every day that see it and feel it first, and they pull back. By the time it gets to Everybody else via mainstream media, things have already changed or it's old news. So when you see stuff happening right now, because I can tell you, it's been a very busy, last week was a very busy week on a number of different levels. Okay, number one, with respect to lead sources, leads coming in for distressed properties, got a whole bunch. All right, number of properties that came across my desk from wholesalers, because there's let's buy and sell property. A ton of them came through, which means people want to move property and sell. Also, a lot of them had reduction in price points, so that's a good sign. So, I can just sort of feel. I see the foreclosure filings increasing. So, when I'm out in the field and I'm talking to people and I'm seeing some of this information firsthand, I get the feel, I get what's going on here. Whereas, what the masses, the majority typically do is we wait to see what Case Shiller, we wait to see what National Association of Realtors says next month, two down the road, 2 months down the road about comps and home price appreciation, whatever. But by that time, we've already started. You're already missing out. You see what I'm trying to say here? So is that being in the forefront of the industry, you see what's happening quicker, better, faster, and you can react and do better off in the end. So just keeping all that in mind, guys. That's kind of what I'm saying right now. So this to me, first wave, let's recap, is what? Pre-pandemic, pre-COVID, legacy foreclosures. Second wave is all the stuff that happened during the pandemic with the foreclosure moratoriums and forbearance and loan mods and things failing and delinquencies and whatever. That's your second wave. Third wave will be a result of those two waves manifesting through the real estate market, plus all the things that are going on in the economy, plus high interest rates, plus people putting the market homes up for sale, plus increased inventory, all those type of things. So that'll drive price points down. People sometimes sell or dump their homes because they don't want to engage, right? Hey, I bought this home at the peak of the market with a high interest rate. If we have a crash, it's going to take me 10 years to get back to normal and recoup my losses. Let's just get rid of it now. A lot of that goes on as well too. So we're going to see a lot of interesting things happen in the next little while here. So, as I said, buckle up. It's going to be a funny ride. So let's summarize. The bubble is here. Okay, there's no doubt the bubble is here. Okay, it's been here for a while, but people just haven't acknowledged it or they've been reticent to acknowledge it. Well, the bubble is bursting. We see it happening right now. This is just the tip of the iceberg. So we haven't seen the true carnage in the housing market take place. We're seeing just the early stuff. We're not even seeing what's really going to happen. The crash begins now. So as I said, 3 waves. Get ready for it. It makes a lot of sense. I can show you what to do. All right. This happens to be a Get Housing Data shot of Cleveland, Ohio. I'm just putting up random locations. Shows that Cleveland, Ohio, as of today, has 1,580 pre-foreclosures. So, as I mentioned, data in the foreclosure world is very difficult to manage, maintain, and understand. I know that there's data services across the board don't keep up or they drop off foreclosures or pre-foreclosures that don't have no activity for a number of years. They make some assumptions. So what we see here is a decent number, 1,580 in the city of Cleveland. I didn't even do the county, it's the city of Cleveland. And I can tell there's probably more than meets the eye of all the legacy ones and stuff they're not picking up on at this point in time. So again, great opportunities here, great opportunities everywhere across the country. We'll be talking about that shortly. So as I always mentioned, looking for more real estate agents in Florida. I'm looking for people to actually join my firm, all right? Not to partner with me or I'll help you. It's like, no, you got to join my firm because that's where the opportunities really are. Looking to open up other metros that make sense for me as well too. Looking for investor buyers who want to buy and participate. Looking for private lending partners, syndication, equity funds, those type of things. One of the things that we're doing with some colleagues of mine and some new real estate ventures is we're doing tokenization of real estate for fractional ownership. That's very interesting. We're also able to sell properties via NFT and crypto. So if you recall, the first property that was sold in North America was down close to where we are in Gulfport, which is really outside St. Petersburg. That was sold as a non-fungible token. And we know the people and we're working with them on doing that on a larger scale who did that. So a lot of cool things are going to happen as time goes on. As I mentioned, I talk to people all the time about this. Hey, short sale program is done. It's evolved to something else. So if you want to get in, give me a shout. There's literally 1 or 2 days left of this. Okay, we got to move on. So best benefits, best price, best opportunity now. I don't know why people are hesitant because now this is actually happening, right? It's really happening. Get in the game. Learn this stuff now. You'll at least get one property at a much, much better price. Okay, be well worth your time and effort. All right. So again, that's how to get a hold of me, Randy at Luxury Short Sales. Make sure you put your phone number in there so we can connect. And once again, I appreciate the views. I appreciate the likes and comments on the videos. Please share the video with your family and friends. If you're not a subscriber, love it if you'd subscribe. We'll look forward to speaking with you later on this week. Thank you.